In the meantime, let's bring in another voice on this record close. Joining us now is Drew Pettit, Director of U.S. Equity Strategy at Citi. Drew, it's great to have you. I'm going to start right there. Stocks at records, broader market at record. Do we go higher from here?
Look, we're getting really close to our year-end 5,100 target. Admittedly, we're still constructive. At the end of the day, we've had a lot of really strong earnings. It's been a great earnings season. I think Mike touched on it before. That's what's driving the market higher. And then on top of that, look, good news is good news right now. Like that's been a big change. If we had this conversation, let's call it 3-6 months ago, higher yields, a little bit hotter inflation print at the beginning of the month, real GDP beating expectations, market might not have reacted well to that. But we're into a new regime right now, and good news is good news.
Okay. So does that mean you take some profits here, or does that mean you continue to pile money into equities?
So I wouldn't say just pile money into equities right now. Like, look, you touched on valuation being a concern for people. We don't think it's as alarming, but look, by no means is the market cheap. Sentiment's starting to get extended. We think it's just way more prudent right now to buy on pullbacks, look for volatility. We still have elections ahead. You know, with valuations higher, that's going to, put some more pressure on earnings to deliver. And if inflation and rates stay a little bit higher for longer than we expect, that just means we need more productivity to drive earnings growth going forward. That means there's going to be volatility. So don't chase, buy the pullback. That's our recommendation to clients.
I mean, it's been another strong week for the big tech stocks, and we've talked about how much of a lift they've done in terms of powering this rally more recently. The NASDAQ, for example, finished this week up 2.3%. That said, though, the Russell 2000 and the Dow Transports also have two handles in terms of their gains for the week. Does the rally broaden out from here, or do you stick with what's been working so far?
So we think it does broaden out from here. Look, we're secular bulls on industrials. We've been talking about this for a long time. There's a lot of business models there that have seen a lot of improvement, better ROEs, better margins through cycles. We think that's going to play out, but we really need earnings growth to inflect. So right now, earnings growth is being driven by mega cap growth, by the growth side of the market. We're another quarter away from seeing small cap earnings growth inflect and seeing the cyclicals more definitively inflect into positive territory. So yeah, it's going to broaden. Might take some time, might be a little bit of a show me story, but I think it's going to happen this year. And we definitely would be buying on pullbacks, and it's buying the cyclicals on pullbacks.
Okay. When you talk about earnings inflecting, I mean, how much does this hinge on cost cuts? How much does this hinge on the top line and revenue continuing to grow?
I don't think it's as top line driven for a lot of businesses as we all think. Even when we look in the mega cap space, some of these companies are seeing earnings growth decelerate year over year. Still positive, but decelerating. But this is a big productivity story, and that shows up in operating leverage. So it's more of a margin story. I don't think it's necessarily cost cuts. I think it's going to be better spending on CapEx initiatives that have near-term cash flow drivers or will drive near-term cash flows. So at the end of the day, yeah, revenues get slow, but earnings can still inflect higher. And that's where we think, that's where we want to stock pick within this market. We think that helps drive the majority of names higher this year.
Over the past week or so, I mean, we've seen Fed funds futures reprice based on what Powell has said and the flurry of Fed speakers we've gotten since then. How much does the bond market matter to equities right now, or is the story more fundamental in terms of earnings?
Right now, it's fundamental. I think longer term, the bond market will matter for what kind of multiple we can sustain on the market. So honestly, I think you need 10 years to probably come in sub 4 again if you're going to get anywhere close to our bull case of 5,700. The Fed probably needs to cut if you're going to have a real blow off top on this market. So until then, look, we're going to make gains. It's going to be very earnings driven. That's kind of the tough part of the year. And rates could give you a tailwind.